There you go.
All right, guys. It's Angelo Christian over here with Real Estate Insider with another great edition. We have a very special guest on our show today. We just learned about Mike the last month. Ladies and gentlemen, welcome Michael Zuber with One Rental at a Time. Michael, thank you so much for coming on the show today.
Hey, Angelo, thanks for reaching out. I like what you're doing there. And first off, let me just tell you, this walking on a treadmill while doing an interview, that I got to do that. I sit too much. So I'm a fan of what you were doing there.
Yeah,
so thank you very much.
I appreciate that. So I don't know, you probably don't know my story because you and I we're actually just meeting everybody. So I used to weigh 400 pounds. Yeah. So I grew up in a family of food and eating and not moving a lot. So I've tried to change my life. So I try to stay very active. I'm actually on this thing for about 10 hours a day.
Oh my gosh.
Yeah. So while I'm doing deals, $100, $200 million deals, $10 million deals, I'm on the phone on my treadmill.
That's great.
Yeah. So, I like to stay active. I don't like to sit,
Mm-hmm.
And so, but no, I'm really excited because when we found you, there's a lot of people in the space, and there's a lot of people that are phony and fake. And then there's a lot of people that try to be real. One of the things that really resonated very well with you is that you seem very sincere and honest.
Yeah.
And we picked you up on a feed that came in about, what's going on with Grant Cardone right now. And so I wanted to, because we're in the real estate, the private equity side, we do a lot of fix and flip, a lot of long-term rentals, a lot of Airbnb. So we wanted to learn more about you today.
Sure. And
exactly what you do, because, to be very clear to the audience and maybe see how our audience can benefit from you.
Sure.
And if there's any opportunities there.
Yeah. And I think my audience will benefit from you as well. We're actually going to publish this video on both channels. So first off about me. So again, One Rental at a Time is kind of what I've grown into. But my story begins as a 30-year-old, W-2 employee who made a lot of money, but spent a lot of money.
Right.
On my 30th birthday, my life changed after reading Rich Dad, Poor Dad. Nobody in my family had any money ever. So I never thought about owning anything. Certainly never thought about owning a second house. I mean, there was always this stretch goal about eventually owning your own home. But after that, it was, having a second home was comical while I was growing up. But lo and behold, I realized if you started to sacrifice, reduce your expenses, you hustled during the day, you learned your market, you could grow a real estate portfolio. My story starts with a single family house and ultimately ends in financial freedom. It was a 15-year journey, which, both you and I have 20 years experience. So, that includes the great run up, the great crash, the great return, and then ultimately ending in what we are now, 2020. I like to talk about with people that have experience. I sort of have called 3 different market turns and profited from them well. In 2006, I sold all my houses and moved into apartments. So I did 1031 exchanges.
Okay.
I sold a house I bought for 107, sold for 264.
Nice.
Ultimately, that was foreclosed at 75. And, 12 years later, it retraded at 171. So it's never even gotten close to the price that I sold it for back in 2006. But lo and behold, the market rolls over. Deals are everywhere. I'm still employed at this time, still making 6 figures, selling software. And, I'm buying stuff at land value. And I'm buying stuff out of the MLS, right? Realtor.com, Redfin, Zillow of the day. And, 40, 50K in Fresno, California, but I can't get any loans, right? I have an 800 credit score, 7-figure net worth, never missed a payment, and I can't get a loan. The banks are telling me to basically F off. Which is happening to lots of people today. Yeah. That's why I like to talk to lenders like yourself, which we'll do in a minute. But I had to find a new way. So I found a hard money lender who charged me 12%, 3 points, but he would loan 80% of purchase. So that helped. Ultimately went to private money when a lot of my friends saw what I was doing and they're like, hey, take my money, all of that. Ultimately, the market returns. It has a great 6-7 year run. I retire from the day job 2.5 years ago.
Okay.
Multifamily keeps getting more expensive because people are following Grant Cardone, bigger is better. They're overpaying. I invested through the last recession, and I know C-class apartment buildings don't do well in recessions. So we sold 3 of our 5 buildings right at the end of 2019, which means we're sitting on a ton of cash right now.
Wow.
And we are going to take advantage of this. I think the next 2 years is going to be all about single family, while multifamily works itself out. There will be lots of workouts. And we'll just repeat what we did in '06. We will sell houses in 1031 exchange into multifamily in 2024, 2025. So it's kind of rinse and repeat for us. Holding forever is not something we do. If somebody wants to overpay for anything I own, I will gladly sell it to them. But that's how I retired, right? With just a simple buy and hold guy who took advantage of market transitions. What I've done recently, where we can sort of connect, is I was bored, right? A type A person who's used to work, running 1,000 miles an hour suddenly has lots of time on his hands. So what I started doing in 18 is I started flipping properties. Basically, I bought the ugly slumlord properties, spent 40, 50K on them, and then sold them to landlords. You could go get, 80, 90% of purchase, 100% of repair if you wanted to, but that lending market's gone now. So there's lots of different ways you can get in this business, lots of things you could do, but we are going to be in a very different landscape, going forward. So, I look forward to hearing about your story, how we got to today.
Yeah.
Angelo. So tell me that, and then we can talk about the future, because the future is going to be different.
Yeah. Thank you, Mike. I appreciate it. Very interesting. And I obviously have some follow-up questions for you too, if you don't mind. So
sure, go for it.
So one of the takeaways that I found was very intriguing, what you just said, is now so to be clear, you guys are moving from multifamily into single family right now.
We are now. Yeah, we will, and now we're going the other way.
Okay. Now can you explain, because we do a lot of funding for investment. But we basically cater to investors, which you'll learn shortly on that side. So can you explain the strategy behind that?
Well, I'm a very simple human being who believes in simple calculations. I can get a better return on my cash or my investment in a house today. There's a lot more of them. There's a lot less competition, and all the new investors, they're really speculators, but investors loosely termed. They're chasing bigger is better. One of the reasons I still speak at meetups is because I want to know what the audience is doing. And for the last 18 to 24 months, everybody has been talking about multifamily. Prices got crazy. And in today's market, where I think we're going to have higher interest rates in the future, I think we are going to have lower economic occupancy. I think we're going to see an expansion in cap rates. All of that is bad for multifamily new purchases, but really bad for multifamily refis when they try to extract via value add. I don't want to be there, but I don't want to sit on my hands. So I think I've got 2 or 3 years to buy houses, let that market reflate as the economy improves in 2021 and 22. And I'll just take the equity like I did the first time, 1031 out of houses into apartments when apartments are crashing in 2023 and houses are rising. Simple.
Yeah, that's interesting that you brought that up. I don't know if you follow any Wall Street guys, but Carl Icahn started shorting commercial mortgages.
I saw that. Yeah. Big time. Yeah.
So it's kind of ties in with what you're saying. And I was actually looking at some of the ETFs, this past week, like XLRE, and they've kind of bounced back. But that it seems like an interesting play. And I know that we're not supposed to follow Carl, but it seems somewhat interesting. Now, are you doing on the single families like a Airbnb type, or a flip, or a buy and hold, or what are we doing?
Really, I have 2 portfolios. So I have buy and holds. That's how I pay my bills, right? I live modestly. I'm not a fancy person, but our bills are covered by our buy and hold portfolio. That'll never change. I frankly, as I've repeatedly said here in the last 2 weeks, I plan to buy more houses buy and hold in 2020 and 21 than I did the last 5 years. I like to take advantage when there's stress. This is what's happening today in single family. Nobody wants to sell, so you're seeing listings collapse. Nobody wants to buy because they're afraid of their job. Lending's tighter. Look at what Chase has done just in the last week.
Yeah.
But what's going to happen as time goes by? Motivated sellers, death, divorce, job transfers, people are going to start raising their hand, and I'm going to pick them up just like I did in 2010. It's a little bit early now. Everybody wants it to start now. It's probably not till July or August, but damn it, I'll be ready.
Yeah,
I'll buy a lot.
That makes a lot of sense. And what market are you in
I only invest in. I live in the Bay Area, so Silicon Valley, but I invest in Fresno, California.
Okay, gotcha. Okay, cool. Well, awesome. That helps to clear up a lot. So, in case that some of the viewers that are watching, what Mike is basically saying is that there's an opportunity for single family because prices may collapse or get a haircut in the near term. So, okay, cool. Well, you asked me who I am. So, like I said, my name is Angelo Christian. I've been in the mortgage space for nearly 2 decades. Started in 2005 as a mortgage broker. I worked for AmeriQuest Mortgage, and that time was one of the biggest subprime lenders in the country.
I remember.
Yeah. Yeah. So Roland Arnall was the president, CEO, and good friends with Mr. Bush at that time. And so he's now passed away, but I got to learn under their model, even though they did some things that were not right, which I, can definitely attest to that. They had a very good business structure, but some of the tactics that they used were not correctly. But some of the business things, as far as how to get leads, how to close deals, stuff like that, sales training. Mm-hmm. So I was very impressed with it because I grew up very poor. Like I told you, I was morbidly obese, weighed 400 pounds, came from a very poor family. Never really had anything. No one in my family ever amounted to much. We had, aspirations, but nobody really did anything big. And I always had dreams to make a change in my life and do something bigger. So I really looked outside of my home for a reference or a hero. So I turned to books. So I immersed myself in learning and reading and really fell in love with Warren Buffett.
Yeah.
Tony Robbins, Jeff Bezos, the robber barons, Carnegie,
yeah.
So, and I looked to them to kind of guide me for the rest of my life. Right. And so even though I didn't know them personally, in spirit, I felt like I was connected with them. And so you mentioned Rich Dad, Poor Dad. When I was 18 years old, I read that book and it changed my life. Yeah. And in the back of the book, it said, go read these books next. And it was Think and Grow Rich and Unlimited Power by Tony Robbins. And at that time, I dropped out of school prior to that in the 6th grade because of the abuse that I got from the teachers and the students because of how fat I was. And so that's why I'm on a treadmill today. So, but
not going back.
Yeah, no, not going back, man. Not going back. You got to stay in control. So,
got it.
And I've always wanted to build a business and change the paradigm from, poverty to something where I had financial independence. And so got into the banking industry and learned what AmeriQuest was doing. And I modeled that, went through the subprime, and built a multi-million-dollar business with my team doing mortgages. And that later, modulated into development. Because they're connected. So we got into single family development in 2007, right before the crash.
Okay.
Right before the crash, late 2006, early 2007, did minor development, spec homes, vertical and horizontal development, and went through the crash. Learned a lot, lost a lot. I wasn't like you. Because I was only 26 when this happened. I didn't understand what was going on. So I didn't realize that the yield curve was inverted and banks were going out of business. I came to work one day and 40 banks had shut down.
I remember that time.
Yeah. And my boss is like, hey man, we're getting ready to, as the shit's getting ready to hit the fan and everyone's going to start jumping out of windows. Like, why? What's going on?
Yeah.
I was too young and naive. So I ended up losing a lot of money. I owned a Sbarro's pizza franchise and an oil and gas company. I was trying to be Warren Buffett when I was 25, 26 years old. But I was smart in the sense that I was able to pivot into federal lending and got into FHA, and got out of the subprime and got into direct lending, becoming a lender. And then from there, just, scaled the company, so we grew it into today, which is an 8-figure company. Wow. And lending nationwide. And we have 2 different platforms today where we do our banking placement for prime customers like a Chase or a Wells. where you can get A paper products, conventional, FHA, VA, USDA. And then we also have a private equity side where we can do, deals at anywhere from master plan communities, multifamily, senior living, student housing, and raising the debt and the equity for investors. And that's mainly what I deal with. Like, prior to our call today, I was helping a large investor, actually a multi-billionaire in Boca Raton, to get debt and equity financing. He has hotels that were under construction that have been halted, and trying to restructure the debt. He's paying believe it or not, 30% interest on probably about $250 million of multifamily hotels that he got from private equity capital out of Wall Street. And we have to redo that debt to take because it's insane.
Oh, no.
And
it's damn near larceny, man.
Yeah.
That's crazy.
Yeah. And so that's that. So we're helping a guy like that. He's got, massive balance sheet. And, and we cater to a lot of investors on the multifamily. One of the things that's different also about us is that we give investors, like you mentioned, for fix and flip, we give investors lines of credit, and they can use the lines of credit for fix and flip or ground up construction or multifamily. And we do a lot of ground up construction for investors for like mobile home parks, senior living, which is kind of a niche, that, because you said a lot of people are chasing multifamily, and it's bidding up some of the prices that to where it doesn't even make sense to even buy. So, and then another thing that's really unique about what we do, you're talking about rentals. We do something called build to rent for single family, which is interesting. Yeah, that Fannie Mae just rolled out. We're a Fannie Mae lender as well. So that's what we do today. We cater to, clients all over the country. We lend nationwide from Hawaii to New York.
Nice.
And we do, private equity loans, and then we also do banking loans. And so, I love what I do. I love to take someone's complicated situation and try to figure out how to make them better.
There you go. One of the things I knew I wanted to talk to you about, and I've been looking forward to this for a week since we've had this set up, is I want my audience to understand how the lending environment changed like 3 weeks ago, right? Because it came out of nowhere. As somebody who invested through the last crash, lending changed, but it changed slowly.
Yeah.
Right. As you know, right. It was a slow ratcheting back. Lending changed overnight. A lot of it could be because of the forbearance, and then service providers, and then Chase, and then Fannie and Freddie coming in with 18-month reserves. It all seemed to happen within like a 15-day window. Oh,
I know. It's insane. It's insane.
How did that feel for you, being in the industry 20 years? It had to come.
It's sad. It really is. It breaks my heart. We probably have about $100 million in business that's just laying there in the graveyard right now. And having to make the call, I have loan officers, but I personally, because the loan officers are too, heartbroken about making the call to their borrower that, it's a first time buyer or a veteran. I'm sorry, you can't get funding right now because, the servicers want a 680 or 740 credit. And when you were approved, you had a 620 credit. That's no longer acceptable.
Right.
And you can't get your house, Mr. Veteran. But, the state of Texas says you can get out of your contract now because of COVID. And it's very sad. We've had a ton of clients that I don't know what to do with them.
Yeah.
We're at a clear to close state, and funding was just pulled, and it's very frustrating, especially because we have a whole team here, to the loan officers, to the loan processors, to the managers. But the biggest thing is the customer, because they had expectations on closing.
Yeah, they were I knew of several people who were waiting for wires to close.
Yeah,
because it changed on a Thursday, and a couple people were crossing their fingers to close Friday. Yeah, and it just never happened.
Yeah. Yeah, and the thing so that's the problem. How the thing that's, I think what's more important is how we responded to it in the solution. So we had to quickly restructure loans. One of the things that's different about us is that we offer free credit repair to our clients. So we quickly went in and started boosting people's credit scores to get them to qualify for the new FHA requirements. Because we're a private lender, we took bank loans and put them to private placement. So in the end of the day, we're able to salvage about 60% of the help the clients. Now, there are some spaces that are completely dead right now, which is like non-QM.
Yeah.
So non-qualified mortgages, those are dead. So if you were doing like a no-doc or a bank statement loan, there's a little bit of no-doc that's still available, but the terms, big haircut on the terms, like 60% LTV. Interest rates are adjusted like 200 basis points higher. Like you mentioned, you have excellent credit. We could get you a no-doc loan, but you're gonna have to pay 8 or 9% interest. So it's not like you're getting. Before, we were doing no documentation for investors at 4 and 5% interest. That market is not here right now, and I don't know if and when it's going to come back.
This is where I wanted this conversation to go. It's really sad that there was an event. It impacted a lot of people with deal flow, but in the grand scheme of things, that will be a small window, right? You go save what you can. You saved 60%, restructured. Some business just won't happen. But going forward, we're going to be operating in a different environment for at least 18 months. That's as far as my crystal ball looks.
Yeah.
And I think lending continues to get tighter here in 2020. And then probably as the economy starts getting back to more of a neutral state, it may start to loosen next year. But I expect what Chase Mortgage has done both on the owner occupant and now equity lines, home equity lines of credit. I expect more banks to follow Chase. And if that happens, man, watch out.
Yeah. It's, the thing that, and we have a lot of capital market calls. And one of the things that's interesting compared to this COVID deal versus 2008, is that these loans, like investor loans, no-doc loans, they were performing very, very well prior to COVID. Right? Because there was large equity, usually 65, 75% LTVs, asset verification. In 2008, it was fundamentally flawed. Then we got zero down.
Oh yeah.
Private loans.
Different lending environment. Totally.
Yeah. So, when we looked at our books, our default rate is so low compared to, 2008. Right. And so, but there's a lot of people have gone to cash. And it seems like the only people that are really making loans right now are like the SBA, balance sheet lenders, and conventional and with Fannie Mae back type loans. And so, I think that and even if now we're moving into the other part of this conversation is what does our world look like, post COVID or going back to work. And it's a good question. A lot of from these capital market calls, they're basically telling us that don't expect to do the loans that you're doing prior to this in 2020. That's not going to happen. These non-QM loans, and it's these large aggregators that are buying up all these loans that are saying that, those loans are pretty much dead. They're not going to come back. Focus on what you can do right now, which is conventional SBA, Fannie Mae, those type of loans. And it's very disheartening, but it's the reality of the situation. And what does that mean to us as investors that are trying to get loans? Well, those loans are still out there, but the thing that I guess, and maybe you have more insight into this than I do. Let's say that America does open back up in May or June. Does that mean that it's okay to go play, jump back into the water?
I don't know. So I think this is. I'm thinking a lot about what JP Morgan is doing, right? JP Morgan is a very conservative bank, even among banks, right? They're probably the most conservative, historically speaking. They were hurt really bad in the last crash, so they're acting early. What I'm wondering is it's only going to go one of two ways. Either they've taken this huge $8 billion reserve for bad debt because they want to balance out Q3, Q4, and Q1, right? As they unlock that write-off. Oh, we didn't need so much. Let me bring it back. That could be an accounting game they're playing. They, of course, can't say that because Wall Street would bust them. But, I was an accountant for many years out of school, so I know the games. So that could be. Or what they're telling us is it's bad because they have credit card data, right? That's one thing that Chase has that you just got to remember, right? They have a lot of credit card data. So they can see what people are buying or not buying. They can see who's paying, not paying. They have all these mortgage forbearance. So my concern is, I actually think what they're telling us, and this is why I want to talk to a lender, I think they're telling us that interest rates for all mortgages will be 2 points higher in 3 or 4 months, just because the risk profile has changed, even for FHA.
Oh, they are. Oh, they absolutely are. So what we've had, and I'm glad you brought that up. Now, because we got all the calls when the Fed cut the rates to zero, am I going to get a 0% mortgage answer? Yeah. You're not. Actually, the rates have gone up.
Exactly.
Because the investors have baked in 200 basis points of risk.
Yeah.
And so you're seeing that the outcome is two things. First thing, if you have bad credit right now, you're not getting a loan.
Yeah.
And it's not me saying that. That's just the world we're in right now. So the biggest thing is you have to work on your credit. That's a key takeaway from this video. You got to get your credit up, and you are going to pay a premium on your interest. And so now obviously if you're a conventional borrower and you can put a large down payment, you can still get a 2 or 3% rate right now. But
yeah, let me ask you about that, because yes, I know you can get that still. I'm still wondering, again, this is crystal ball stuff. Nobody knows, we're completely guessing, but hey, we've got 40 years between us. So, hey, I'm wondering, let's just say the lowest loan you can get today is 2 3/4. Let's make it up. Best credit, most down, all that stuff. I'm going to guess come like September, October, the lowest rate that same person can get's like 4.5. I think interest rates are going to go up because the servicers are not as protected as they thought they were. They're going to have more reserves. It's this whole forbearance thing has this unintended consequence of proving that we have risk in a system that we didn't think we had before. So I think all interest rates, even the perfect 850 credit score, millionaire is going to have to pay 4.5 versus 2 3/4. Maybe I'm wrong, but that's what I see, and I'm curious what you think.
Well, so now you're saying that this is the thing. Like if you look at the Fed funds rate, if you look at their calendar, it doesn't show there's any movement for the next 12 months on the horizon. So
it's probably years. Yeah.
Yeah. So I mean, where it would come from is yes, the servicers or the investors adding the basis points in, and so
exactly. Yep.
Not from
That's
the
what
Fed,
I'm saying.
so from the 10-year. So it would be a situation where, like I just said, where for example, if someone has a 600 credit score right now, in theory they could get an FHA loan if the lender is willing to make it. But I promise you, that's going to come with probably 3 to 4 discount points.
Yeah.
Because of the cost of the embedded risk, because they don't know what this thing's going to be worth. Because what's happened to us, I can tell you just for an example, we went to go lock those loans, and the bid on those loans, normally we can sell them for 102, 103. The bid on them is 80 cents on the dollar. So you know what that means is that those whoever those lenders are, they're going to inventory those loans and hope that the market comes back. And they better have a large balance sheet. That's why a lot of these lenders that are servicers are really nervous right now.
Yeah.
Because they're having to cover that swap for the customers they can't make the payments, and you better have a lot of cash on your balance sheet to be able to swallow that. Because I don't know if you saw that so far there hasn't been any relief for servicers.
No, not. I mean, I keep thinking it's coming, but it hasn't happened yet. Yeah.
Yeah. So it's we're not a servicer. So and there's been a lot of mortgage companies that I know of. I mean, I won't say any names, but they do service. And depending on how long this persists for, they could be in big trouble.
Yeah, I mean, they had 2 million mortgage forbearances within the first 14 days based on an article I read. And I read an article either this morning or yesterday that they're up to 4 million. And it's not slowing down, right? We have 22 million newly unemployed in the last month.
Yeah.
It's not helping. And then we have all these, bank, like Neiman Marcus just declared they're going to go bankrupt, 24-Hour Fitness. It's just crumbling around us. So the other thing I wanted to talk to a lender about is not only do I think interest rates will be up by the end of the year, But I think JP Morgan Chase is telling us they think values are going to come down. So that's what I think. That's what I think's happening. I think it's just transactions are going to come down. Lending, and as an investor, my side, it's all about where I stand on the greed versus fear index. How comfortable am I in that? And today, everybody is so far over on fear. Nobody wants to take a risk. So there's nobody going to be writing offers. And when there's nobody writing offers and you have forced sellers, what are called motivated sellers, pricing is going to come down. And then if you look at a bifurcated market, I think there's two markets. There's the high end, which I'll call anything above the median. That market is toast. And then there's the affordable market, which is the median and below. There's just a general lack of supply. So that market will always have a bid, but even that part of the market's going to slow down. So God, if you were a flipper at 2x the median and you're sitting on an empty house right now, oh my God, you're in trouble. Just like 08, this is happening again. I knew a flipper who had $10 million solid net worth that once he lost his first house, they all just fell and he had to claim bankruptcy shortly thereafter.
Oh, really?
It's painful.
Wow, that's crazy, man. And let me ask you on that. So, because that's a good point that you brought up. If you think that the real estate market is going to take a haircut, do you wait a little? You said June or July. Is that kind of like your entry point? This again. I love this game. I've been in the game. I look at my market every day. So as you know, sellers look at yesterday's prices. As an investor, I look at tomorrow's prices. And right now there's a big gap, right? I think tomorrow, just use a real example. This week I offered on a house that was listed for $150K. That's yesterday's price. I offered $100,000, right? So the seller tells me to F off, which they should, but I planted the flag and said, hey, this house is worth 100. Call me back in 30 or 45 days. Who knows? Maybe they sell it for 140, 135, who knows? But I'm going to make a lot of offers this year. I'm going to buy a lot of houses at 100K, again, just in that example, tomorrow's prices. But I'm going to only buy for motivated sellers. Yeah.
If you can hold your house and you don't want to move, I'm not your buyer. But if you need to move to Texas or you live on the East Coast and your father and mother passed away and you need to sell, I'm going to buy as many of those as I can.
So, and inherently what will happen is that we'll adjust the comps. And then therefore,
of course.
Yeah. So, and then, obviously bring down prices. And then realtors will look at, if you did pick it up for 100, hey, this just sold for 100. This is the new market. So
exactly. It'll the feedback loop is real. And the best year for me to invest was 2010 because you had multiple comps coming in at the new price point. And it just became easy because that's the number, right? In that case, obviously the banks were the seller. So it's a non-emotional seller. So it's like, oh, show me a spreadsheet. Next door sold for that. Great, I'll sell it. But it's going to happen again, except it'll be slower because one thing banks do is they sell fast, right? Tom, Dick, and Harry, Mary, Susan, and Martha, they sell whenever they want to. It's just a different rhythm.
Yeah. I got a question for you, Mike, just real quick. I know we're wrapping up here. I do have a question though on because the stock market has like this V bounce, right?
Yeah.
This V, and so it sounds like from what you're saying that you think that the real estate market is not going to take this V-shaped bounce. And you think that we're headed down.
Well, first off, I think we're going to have a W, just if we want to keep using letters. So I think we've had the artificial bounce. I think we've had artificial encouragement about the health side of this, i.e. vaccines, treatments, all of that. We are very quickly going to realize that Main Street is messed up. Neiman Marcus is going to declare bankruptcy. I don't want to hear any more about the high end being okay and insulated. Neiman freaking Marcus is going bankrupt before Macy's, before JCPenney's.
Wow.
Just stop the madness, people. This Main Street is in trouble. They couldn't last a month. We're going to have there will be a down leg in the market, and that'll just have that will lead to the stock market. Now, I also believe there are real estate markets, which are called MSAs, that are more at risk. Where I live, the Bay Area, LA, Manhattan, those three MSAs, Las Vegas, train wreck, 40% haircut coming, easy. I think there's much of the country, it's going to end up being 5 or 6%. I don't think most of the US is going to have the same haircut, but there are unaffordable MSAs. You couldn't make me buy in the Bay Area, New York, LA or Vegas today.
Yeah.
There's no chance.
So you think there's like the stock market, that it's like a dead cat bounce, that we're going lower?
Well, I think it's machine driven. I think it's a bunch of Wall Street people trying to get Main Street to, stick their money in. They're going to take it from us again. I do not have a great opinion of Wall Street. I think it is the largest rigged casino against the average Joe. And I think there's a lot of people that are going to lose, and they're going to believe this. There's an 800-point rally because Gilead had a drug that helped 120 people in Chicago that were on ventilators. Really? That's your sample size you're going to get excited about? Really?
Yeah.
It's just crazy what goes on.
Yeah. No, it's I agree. It's been interesting how fast that rally came on, and I think that the risk is, my personal opinion, because I invest in the market, is that there is risk to the downside. That's my opinion that I'm still really nervous about.
Yeah, lots of my friends know that they call me a crisis investor, right? Because I will not even look at the stock market until it's down 50%. Won't even look.
Yeah, that's good. Contrarian. I like it.
Yeah.
So, well, cool, man. I'm really happy I'm really glad that I got to meet you today and learn more about you. It's been extremely enlightening to learn about your mind, and your business and what you're doing with the future. So how can people, follow you or find you? How can they learn about you more?
Yeah, really. I'm a simple person. The best way to find me is to go to my YouTube channel called One Rental at a Time. Hit subscribe. I actually put out daily original content, 7 days a week, 365 days a year, typically 2 or 3 videos a day.
Wow.
I'm a morning person, so I get it all done by 9 a.m. traditionally. Okay. So that's where I would go. If you want to read our story, go to Amazon or Audible and buy the book One Rental at a Time.
Oh, you actually have a book too?
I do. And if you send me your address later, or I'll send it to your office.
Awesome.
I'll autograph it for you. Cool. So for my audience that wants to get a hold of lending and maybe look at some options, how can they get a hold of you or understand what your business is?
Yeah, for sure. I appreciate that. So we do lend nationwide. We do a ton of business in California. But they can contact us at 832-431-6331 or go to officialangelochristian.com. We have a YouTube channel too. That's usually how most of our clients find us, is on YouTube or social media. Mm-hmm. And then they apply right there. It's just Angelo Christian. And we're open, 7 days a week for business. They can call or text or email and get in touch with the lender. And, we'll do everything. That's our mantra. We'll do everything in our power to figure out how to serve you, to give you the best service. We're a very service-oriented company. And so we always try to figure out a solution where most lenders say no. We try to figure out how to structure the loan, how to help you. I've been, really, really grateful for you today for spending the time with us on the show. And so guys, please check out Mike with One Rental at a Time. Get a copy of his book. Reach out to me. He has very great content. Like I said, I learned a lot from him watching some of his reviews. I mean, really, really phenomenal. So thank you so much, Mike. Take care. Be safe out there. Best of luck with your portfolio, okay?
Thanks, buddy.
Bye-bye. Bye-bye.
Bye.